welcome back to the deep dive. If you've been keeping an eye on finance, you know stablecoins. Well, they're not just for crypto exchanges anymore.
Not at all.
They seem to be rapidly becoming like the actual infrastructure, the settlement layer for modern institutional finance.
That's exactly right. We're talking potentially trillions moving, not just, thousands like in the early days.
Right.
But there's this huge disconnect, isn't there? If the tech is so fundamental, why are the big players, banks, credit unions, the large fintechs, why are they still sort of holding back?
Yeah, hesitant is a good word.
The technology feels mature enough, but institutional adoption. It's moving at a glacial pace, it seems.
And that glacial pace, that hesitation, that's exactly what we're going deep on today.
Okay.
We've got a stack of material here detailing the Metallicus Stablecoin Pilot Program, and this system seems specifically designed to tackle that exact institutional hesitation head-on. It's pitched as this regulatory-aligned, zero-risk environment, built so these massive institutions can safely dip their toes in, explore stablecoin issuance, settlement, the whole thing.
It sounds like the bridge they've been waiting for, maybe.
Yeah.
Because traditional finance, it runs on avoiding risk, right? That's its core philosophy.
Absolutely.
And blockchain, let's be honest, has historically felt a bit like the Wild West. You can't just hand a bank some blockchain tools and say, go. You absolutely have to remove those perceived risks first.
Okay, so let's unpack those risks. Before an institution really jumped in, what are the big barriers? What specific uncertainties are slowing things down?
Well, the first one, and you could argue it's the biggest, is regulatory risk. Simple as that.
Okay.
With a totally new asset class like this, there's just this persistent lack of clarity on custody rules, supervisory frameworks, and maybe the biggest kicker for a bank's balance sheet, capital treatment.
Okay, let's pause right there. Capital treatment. That sounds technical, but it's really where the rubber meets the road for a bank, isn't it?
Absolutely critical.
What does that functionally mean when we're talking about a digital asset?
It boils down to how much money, how much of its own capital a bank has to hold against the risk of dealing with that asset. If regulators haven't given clear guidance on how risky they view a specific stablecoin, the bank has to be super conservative. They have to set aside potentially huge amounts of capital.
Which makes the whole thing maybe uneconomical from the start.
Exactly. It can kill the business case before it even gets off the ground.
Yeah.
Banks need certainty on capital requirements. They just can't operate without it.
Right. Can't innovate if the cost of just existing with the innovation is punitive. Okay, so that's regulatory risk. Barrier number 2 you flagged hits their internal workings. Operational risks.
Yeah, this is the internal engineering nightmare, potentially.
Okay.
Just think about it. You've got systems, some maybe built back in the 80s, running on mainframes, established protocols, and you're trying to make them talk seamlessly with this evolving, fast-moving, often open-source blockchain tech. It's a massive integration challenge.
And if it goes wrong?
If it goes wrong, you risk interrupting core banking services, which is, bad, very bad.
Understatement. Okay, and then the third barrier, sometimes the quietest, but often the most powerful. Reputation risk.
Oh, absolutely. This one looms large. An institution wants to look innovative, sure.
Of course.
But they absolutely cannot afford a big public compliance failure or a security breach involving a new digital asset class. Customer trust is everything.
Paramount.
One major misstep there, and years, maybe decades, of brand building and trust could just evaporate.
Okay, the barriers are crystal clear. Regulatory fog, operational complexity, and the fear of damaging that hard-won reputation. So the big question, how does this Metallicus pilot actually let institutions take the leap without taking on what sounds like potentially catastrophic risk?
That's really the clever part of the design, I think.
Yeah.
They recognize you have to solve all 3 problems at once.
Right.
Which brings us straight to the first key feature of the program, the zero-risk test environment.
Okay, that sounds significant. Removing the risk. How does that actually work in practice?
So institutions can run full-scale, like production-grade payment flows, internally or even between participating peer institutions, all within this dedicated environment.
Right.
But here's the crucial part. They're validating all the technical integrations, the messaging formats, the compliance checks, without ever needing custody of digital assets. And critically, without touching real money or their actual balance sheet. It's testing at production speed and scale, but totally insulated.
Let me just jump in there, because for a CFO at a major bank, hearing no balance sheet impact, that's probably the biggest green light imaginable, right?
Huge, absolutely.
They can test drive a potential new revenue stream, stress test their tech integrations, learn the ropes, all while their capital position stays completely untouched. They don't have to allocate a single dollar of regulatory capital against this experiment.
That's precisely the goal. It directly neutralizes the scariest parts of operational risk, the integration failures, and regulatory risk, the capital uncertainty, by creating this perfect mimic of the real world, but without any financial consequences if something breaks during testing.
Makes sense. But the program isn't just about testing existing stuff, is it? The materials talk about proprietary stablecoin deployment, letting institutions issue their own custom stablecoin.
That's right.
Doesn't that risk creating a bunch of new walled gardens, though? Defeating the whole point of an interoperable network?
It's a really good question and a valid concern. But the way it's structured seems to anticipate that.
How so?
The institution gets to issue a custom coin, yes. One that's tailored precisely to their internal policies, their controls, their specific governance needs. It reflects their compliance comfort level.
Okay.
But, and this is key, it's specifically engineered from the ground up to be fully interoperable. It's designed to work with established public networks, think Ethereum, and with the big existing stablecoins like USDC.
Got it. So they get the internal control and compliance wrapping they need for their own peace of mind.
Exactly.
But the coin itself isn't stuck in a silo. It can still talk to the broader digital asset ecosystem. That addresses the isolation worry.
Precisely. It aims for the best of both worlds. And, none of this really works smoothly without the third pillar they mention, expert core developer support.
Right, the human element.
Yeah. Metallicus apparently brings over a decade of experience doing this bridging complex blockchain stuff with deep banking and compliance knowledge.
So they're not just providing the sandbox, they're providing the guides.
Kind of, yeah. They provide the underlying infrastructure and the advisory support. It's all designed for scale, performance, and importantly, regulatory assurance. They're like the compliance co-pilot, helping minimize that operational risk during setup and testing.
Which saves the institution the massive headache and cost of trying to hire or train up their own specialized blockchain compliance engineers from scratch, presumably.
You'd think so. It lowers the barrier to entry significantly.
Okay, so that covers the pilot, the sandbox phase. But the materials are quite clear. This isn't just a temporary experiment. It's positioned as the official gateway into the digital banking network, or TDBN.
Yes, TDBN.
What's the strategic significance there? What is TDBN, and what's the end game?
TDBN is presented as the destination, the long-term shared infrastructure that these institutions eventually plug into.
So graduating from the pilot.
Exactly. Once an institution moves through the pilot successfully and joins TDBN, they stop being just an isolated tester. They become part of this larger, cohesive network.
And what does joining TDBN actually give them? What are the practical benefits?
Well, 3 things really stand out from this course material. First, seamless interoperability with all the other institutional stablecoins on the network. No more custom integrations needed for each counterparty on TDBN.
Okay, network effects.
Second, access to deeper settlement and liquidity across a potentially wider range of high-quality, blue-chip digital assets, not just their own stablecoin. And third, and this is crucial for the long run, they become part of a shared compliance framework, one that's presumably already been vetted and approved by regulators and auditors.
So they're effectively mutualizing a huge chunk of the ongoing compliance burden and cost.
That seems to be the idea. Leverage the network's pre-approved standards.
Now, speaking of standards, I think maybe the most important detail we found about TDBN is its explicit alignment with existing financial plumbing, specifically ISO 2022 and FedNow standards.
Yes, that cannot be overstated. That's huge.
Why is that so critical? Let's break it down. ISO 2022.
Right. ISO 2022 is the new global standard for rich financial messaging. It's not just about sending the payment instruction, it's about sending a huge amount of structured data with the payment.
Like what kind of data?
Compliance data, KYC information, settlement instructions, remittance details, all bundled together in a standardized format that global systems understand.
So it basically solves a massive regulatory reporting problem for cross-border complex B2B payments using stablecoins.
Fundamentally, yes. You're not just moving a token, you're moving the entire context and compliance trail along with it in a way existing systems can digest.
And aligning with FedNow.
That ensures the speed matches expectations. FedNow is the U.S. instant payment infrastructure. Aligning with it means blockchain-based settlement can plug directly into the real-time gross settlement expectations of modern domestic finance.
It's bridging the gap, making the new tech talk the language of the old infrastructure.
It's combining the revolutionary potential of blockchain with the absolute necessity of standardization for regulated institutions. That right there feels like the key to unlocking mass adoption.
Okay, let's pull back and summarize the big picture, the strategic benefits. If you're sitting inside a financial institution right now, maybe feeling that pressure to innovate but worried about the risks, this answers the why should we even look at this pilot question.
Right. First off, you get risk-free exploration, period.
Yeah.
You learn, you test, you integrate with absolutely zero impact on your balance sheet or custody operations during that phase.
That's the big one. Second,
you're enabling compliance-aligned innovation. You're not building something in a vacuum hoping regulators will approve it later. You're building within a framework designed for regulatory scrutiny. What you build today is less likely to be obsolete tomorrow due to new rules.
Peace of mind there. What else?
You gain potential first-mover advantage. By getting comfortable with the tech and the network early, you position your institution to understand the standards, maybe even influence them, and be ready to capture market share when stablecoin settlement really takes off.
Being ahead of the curve.
And finally, it provides a clear path for future-ready scaling. The pilot isn't a dead end. It's designed as a smooth, de-risked on-ramp directly into the production-ready digital banking network. It takes the guesswork out of how do we go from test to live.
So it removes that scaling uncertainty.
Ultimately, yeah, the core message from the material seems to be this pilot tackles the big barriers, regulatory, operational, reputational. It validates the compliance approach upfront, and it provides that necessary standardized pathway into TDBN.
Which they're positioning as the future interoperable settlement layer.
Exactly. The takeaway is The era of institutional stablecoins might finally be here, but only if it adheres to these kinds of established standards.
And that alignment piece with ISO 2022, with FedNow, that feels like the critical insight. It makes it a systemic solution, not just a shiny new tech tool. It offers the stability institutions absolutely require.
Couldn't agree more.
We've seen just how vital that deep integration with existing infrastructure is for launching anything at a global scale, which, it gets you thinking. If this level of success really hinges on meshing seamlessly with established financial standards like payment messaging and real-time settlement, what's the next big, maybe slightly boring established standard? Perhaps something around, say, global trade finance documentation or custody reporting frameworks.
Yeah.
What's the next compatibility hurdle the digital banking network will need to clear to achieve truly global reach?
That's a fascinating question.
That's the strategic question you probably need to be asking yourself right now.